With war in the headlines, volatility in the market, and uncertainty everywhere you look, retirees need to be asking a better question. Not what is the market going to do next, but is my portfolio actually structured to handle a bear market if one comes? We're going to cover this and how to protect yourself today on the Howdy Neighbor Retirement Show.
It's the Howdy Neighbor Retirement Show.
Howdy neighbor, I'm Michael Andrews with Andrews Insurance and Advisory, and you're listening to the Howdy Neighbor Retirement Show, where we tackle real-life questions about retirement, Medicare, and Social Security every week. Today is going to be another full-blown Michael tutorial, backed by popular demand, I might add, and we're going to be talking about market volatility, retirement income, and why retirees need to stop asking, what is the market going to do next, and start asking whether their portfolio is actually structured to survive a bear market. Now, let me be clear right out of the gate here. I'm not here predicting a bear market, and I'm not trying to tell you that I know what the stock market is going to do next, because I don't. And neither does anybody else. There are people that make a living trying to predict that stuff every single day, and most of the time they just end up looking foolish. But what I am telling you is this: if you are retired or you're close to retirement, your portfolio should be already structured to handle a bear market if one comes. Not because we know what is coming tomorrow, and not because we know what is coming, but because downturns are a part of investing. And if your plan only works when the market is going up, then that is not much of a retirement plan, in my opinion. That is really the whole point of this week's Michael tutorial. When you are working and building wealth, a down market is usually more of an annoyance than anything else. You keep putting money in, you keep buying, and over time you generally come out ahead. But when you are retired and you're living off of that money, it is a completely different ballgame. At that point, a bad market is not just something you wait out mentally. It can directly affect your income if your portfolio is not set up the right way. So the first thing that you have to figure out is you got to figure out your budget. How much money do you need to come from your investments each year once you factor in other things that you're getting in no matter what? Things like Social Security, pension income, annuities, if you've got rental income or anything like that. But that's where your starting point is. And then you have to be honest about whether that number is realistic. So for example, if someone has $500,000 saved and they think they need to pull out $100,000 a year out of that account just to live on, I hate to break it to you, but that's probably not going to work. So before you ever start talking about stocks, bonds, or anything else, you need to know what your portfolio is being asked to do and whether it can realistically do that. Because if you don't know the income number, then you really cannot build that portfolio the right way in the first place. So once you understand that, then the next step is structuring the portfolio around it. Let's say that you need $40,000 a year from your investments. What I don't want is for someone to have to turn around and sell stock investments at a loss in a bad market just to create that income. That is where retirement portfolios can really take some big time damage. So what I like to do is this. I like to think in terms of buckets. If you need $40,000 a year, then maybe we set aside about 5 years of that income. So roughly about $200,000, and we put that into a short-term spending bucket. That money is not there to hit home runs, but it is there to do a job. So you can put those in CDs, money markets, short-term bonds, or target maturity bond ETFs. Things that are meant to be more stable and there when you need them. That way, if the market drops, you are not forced to go and sell growth investments at the worst possible time. You already have money set aside for income, so instead of panicking, you simply pull that short-term bucket and give the stock side of the portfolio time to recover. And this is where the example really starts to make sense. If somebody has $1 million portfolio and they need $40,000 a year from it, but the whole thing is invested in a way where they have to keep selling from a market no matter what, a 20% drop starts to feel very different. Now, all of a sudden, that $1 million is worth $800,000 on paper, and they are still having to pull that income out of it no matter what, and that is a terrible combination. But if they already have several years of income set aside, then a downturn becomes a lot easier to ride through because they are not having to sell those investments that are down just to pay the bills. Then after that, in years where the market has been good, you simply refill the bucket. You take gains from the growth side, Move another year or so of income over to the short-term side and then keep the plan going. If the market has a bad year, you leave the growth side alone and keep living off the money that was already set aside. It's a pretty simple idea, but it gives people a much better way to handle retirement income than just hoping the market cooperates every year. And I will tell you this too. If you are retired, or if you're getting close to retirement and your advisor has never sat down and had this conversation with you, if nobody has ever explained how your portfolio is structured to help cushion a bear market, that should probably be a red flag, because in my opinion, this is where the financial advisory business is headed. The days of just throwing somebody into some generic 60-40 stock to bond mix and then pulling 4% out a year and calling it a retirement plan, I think those days are coming to an end. Real retirement planning is more individual than that. It's more thoughtful than that. It should be a back and forth process, and it should be based on your income needs, your risk tolerance, your other income sources, and what you actually need that money to do for you. And when you walk away from a review with your advisor, well, you should feel more confident, not more confused. You should not feel like you just got hit with a bunch of financial jargon that didn't make any sense to you, and you felt too uncomfortable to even ask a question about it. A good retirement plan should make sense to you, because at the end of the day, this is your retirement and this is your money. So today, we talked about why retirees need to stop focusing so much on trying to guess what the market is going to do next and start focusing on whether their portfolio is actually built to handle a downturn. We talked about how retirement is different than the years when you are still working and building, because once you're living off your investments, a bad market can do a whole lot more damage if your money is not structured the right way. And we talked about one simple way to think about that. Figuring out what your income need is, setting aside a short-term spending bucket, and giving your long-term investments time to recover instead of selling them at the worst possible time. That is the kind of planning that can give people a whole lot more confidence in retirement, especially when the headlines get ugly and the market gets volatile. So if you got a question that you would like for me to tackle on the show, shoot me an email at michael@andrewsadv.com. I read every single one of them, and I just might answer yours on a future episode. You've worked hard to build your retirement, and you don't have to make these decisions alone. If you want a second opinion on your retirement plan, well, I'm here to help you. It doesn't cost anything for me to take a look, but not letting me, man, it could cost you thousands. So if you're ready to take this relationship to the next level, you can call or text me at 918-842-7379 or head over to andrewsadv.com and click on my calendar to schedule a time that works for you. Before you go, hit subscribe on YouTube so you don't miss next week's episode, and follow the Howdy Neighbor Retirement Show page on Facebook too. If you found this helpful, give it a like, leave a comment, and if you could, share it with a friend who could use some good neighborly retirement advice. Thanks again for listening, and we will see you all next week right here on the Howdy Neighbor Retirement Show. Thanks.
It's the Howdy Neighbor Retirement Show, helping you plan so your money will grow.